Yeah, let's start with the one that I was waiting to see then. So Rightmove, a stock that you and I own, and I was desperate to talk about with Paul, but he's unfortunately not here. Has been reporting its earnings today. It reported earnings for the full year, so let's talk about those then. So the revenue for the year was 333 million, which was up from 305 million, which I think is about a 9% increase. Earnings per share were 23.4p, up from 21.3p. Membership was fairly flat, with the number of agents on their platform down slightly and the number of builders on their platform, home builders that is, up. And the average revenue per advertiser was 11% higher, which was the second highest year it's ever had for growth. And it's guiding for more growth in 2023. So this was taking us to the end of 2022, that last year. Their year ends in December, like most years do. They sent out 198 million in buybacks. This is a stock that makes about combination of dividends and buybacks. It gets you about a 4.5% return. And I was going to ask Paul about this and say, look, Paul, this is a company that has the kind of attitude that he wants, which is we're going to take all of our kind of cash that we don't really know what to do with, because our business doesn't take very much to run, and we're going to fling it at shareholders. We'll mostly by buying back stock, but partly by dividends. So the dividends up for the year by around 9% or so. That all sounded like decent news. Shares were down 2% on the news because it was roughly in line with what was being forecasted and so on. There's a couple of things there that I suppose might be slight risks. There was some really interesting stuff, I thought, in the management commentary. But Steve, what do you think about Rightmove or any of that?
It was surprising to see it do so well, really, especially off the back of we've had Taylor Wimpey and Persimmon's reports come through, and Taylor Wimpey's report wasn't too bad. They've raised the dividend a little bit, but Persimmon have taken the Intel route and basically chopped 3/4 of the dividend away. So it was interesting to see that even despite this, Rightmove is in a fairly decent position. I mean, when we first talked about Rightmove, we just said if the housing market declines, Rightmove will just do less well. But it wouldn't even say that that's what they've particularly done. They look like they're in a pretty decent position to me. Obviously, they're not that reliant on new homes being built, but that is all part of the broader market, especially with interest rates flying. You know, major house builders reporting slowing and high cancellation rates. It's interesting to see Rightmove still just chugging along, Steve.
Yeah, chugging along is the thing. It's sort of 9% or so growth pretty much across the board. You might ask yourself whether you're happy with 9% growth, I suppose, from your 24 PE stock that you were buying. I mean, I think both you and I bought it at a bit less than a 24 PE in fairness, but thinking about it at today's prices, that's where that gets you to. The end of last year, of course, and the very tail end of last year, so included in these latest results, featured a lot of kind of heavy work around interest rates, and we had some chaos in the mortgage markets as well, as the sort of mini budget stuff was making headlines and driving mortgage rates, well, in some cases taking mortgages just off the market completely, but pushing rates of other ones up. And that doesn't seem to have made that much difference to this company in terms of where it showed up. Because when we've talked about it before, we've always said, look, the risk is a slowdown in the UK property market. And does the UK property market currently look expensive? Yeah, it kind of does, to be honest. Rates are pretty low, mortgages are pretty low, so people buying houses for more. It won't stay like that forever. It can't stay like that forever. This company's presumably going to take a hit when that happens. And it doesn't really, and one of the things the CEO said to me, to investors, but I read, was particularly interesting. It said, while we remain alert to the ongoing economic uncertainty, Rightmove is not materially impacted by the property market cycle other than in the most extreme circumstances. So they think then that they're going to kind of keep pushing on okay as a very good business, unless something really, really kind of heavy happens to the property market, which I guess is good, I suppose. It's a secular grower rather than a property market cyclical thing.
Yeah, and that's exactly what they are, isn't it? Which is, you know, I think we pretty much nailed that when we spoke about it. So yeah, impressive, really. Business still churning out loads of free cash, and like you say, spending it on making people like Paul really, really happy.
Yeah, I mean, not Paul specifically, right? People like, I don't think Paul owns a stock, despite our best efforts of convincing him that it's really a passive income stock or something like that. One other thing that he said, which I quite like, because it's rare that companies that I own get to say things like this. As the increased inflationary backdrop is not expected to materially impact costs, which does make sense. They don't have that high input from kind of raw materials and stuff. And we expect an underlying operating margin for 2023 of around 73%, which is, I mean, that's, we're going to talk in a little bit about some kind of tech companies that are, I want to say immature, right? But they're further back in their kind of scaling and growing process. Rightmove is pretty much a mature business here. I mean, it's behaving like a mature business, right? Make money, ship it out to people because you don't have much else you can do. There are a couple of kind of growth areas that they pointed out, with stuff like industrial property listing, or commercial property listing, I think more accurately. But leaving aside that thought for a moment, they are currently behaving like a mature business is, quote unquote, supposed to. They make money, they don't bother sitting around with it, they send it back out to investors in whatever way they think most appropriate, whether that's dividends or buybacks or whatever. But we sometimes think about these kind of growthier, younger, less mature businesses and wonder, well, what are the margins going to look like in the end? It's rare that I think either of us ever think, yeah, they're going to be about 73% operating margins, and I think either of us would find it quite hard to meaningfully defend that if we ever did say that on the show.
They've got to such a strange scale, haven't they? Evidently, where they just don't seem to need an awful lot of people to keep it going. They're on. It must be on minimum staffing levels. You can't imagine they need, but they've always been a fairly lean business. It's just recently they've just turned into this super business. I think when you're modelling a growth story, you sort of sometimes put in 20 or something like that, and you really sometimes you do it through gritted teeth, and you think, well, probably we won't get anywhere near that. But putting in 70, Steve, that'd be like the stuff we used to laugh at on YouTube, like the pie in the sky. Like when it gets 70% of the 5 trillion market, yeah, it's not gonna do that. And then Rightmove's just come and soaked it up. I think it's one of those things that's like, I don't think you can take anything from it. I don't think there's anything to be learnt from it other than that Rightmove is, as we said on a number of occasions, a really, really good UK business.
Yeah, it'll be interesting. They have a change of guard coming up. In fact, I think that may have just happened, actually, in that Peter Brooks Johnson, who was authoring the last report as CEO, because that ran till the end of December, but I think the change happened in February. In comes a new CEO then. We'll see how that kind of goes, because this is a business that I think, well, to my mind, it fits into the category of anyone can run this thing, because you don't have to do an awful lot to run it. It maintains its competitive position by way of a network effect. It doesn't take an awful lot of capital to run. All you have to do is just press the button that pays the dividend and stuff. Basically, right?
I quite like that as an idea, that he's just sat there with, like, he's got a pen pot, but he just uses the pens to press one of the 2 buttons, dividend or buyback. Yeah, I like it.
But that's pretty much it for Rightmove. I was looking for things to dislike about this, because we normally like to talk about kind of risks and downsides and stuff, and we normally say the property market might go down quite a lot, but we kind of deprived ourselves of that particular option. When I was digging around, the only thing I could find was issues around complacency. I mean, I get the thought here. You fail to innovate, then you do eventually invite trouble on yourself. We don't need to point out kind of tech companies that have had dominant positions and kind of sat idle paying away dividends and buybacks and so on, which we're sort of loosely positive about this for. But they are claiming to be innovative. They're claiming to be kind of moving things forward. Is there a danger that someone comes around and eats their lunch here? It doesn't strike me as obvious, but
there's always a chance. I don't think that I see anything on the particular horizon. I think there's nothing wrong with the Rightmove app, and I think that's probably the big problem for anybody who wants to come along and disrupt it. It's like, well, what are you going to, what exactly is wrong with it? Do you know what's wrong with it as a service? What could you do better? And I think I don't really know anybody outside of the estate agents who complain about it, but they complain about it because they have to pay for something that they previously, put on their stupid websites with their stupid names that were really difficult to remember, and they got your email address and phone call and never ever deleted it off the databases, and probably sold all your data to third-party people. So, that's a better. Rightmove is a better service than that. And if something comes along that's better than Rightmove for the consumer, then I suppose that is even even better, but I don't see what that is
No.
at the
Two
moment.
quick thoughts on that, I guess. Once is, I was talking to ISA Investor a while ago now, actually. He kind of asked me, well, what is it that Rightmove has or can do that can't just be done by sticking your house on Facebook Marketplace? And if enough of us decide to do it and make that the place that people go to go and look at houses. And I think the answer is not an awful lot. There are some things there that are distinctively Rightmove's kind of added on stuff, but nothing that I would kind of say. The main reason that I go there is clearly because that's where all the houses are listed, right? So why couldn't that be somewhere else? And it's a good question. I think the answer is not an awful lot, but that's kind of how network effect moats work from what I can see of it. I mean, I remember asking the same question of Facebook sort of back in 2005 or 6 or something of what do I want to be on this thing for? I can send people pictures, I can send them messages. It basically at this stage doesn't do anything else, but the reason I'm on this platform is because everybody else is on this platform. That's where all the people are in a certain way, and that I think is kind of the point of these sort of network effect moats. They can unravel. I mean, if people start going away, then the whole thing starts coming down as quickly as it went up again. But it does kind of look to me like that's the answer to sort of Isa's question. Not an awful lot, but once you're set up in this situation, you have a kind of advantage that comes from that sort of network effect.
Yeah, and I think the other thing is it's lack of distraction, isn't it? So when you're going on to Rightmove, you know you're going to be looking at houses, whereas you go onto Facebook Marketplace and you probably end up getting distracted by whatever's happening. So, yeah, I don't think that's... It's a specialism, isn't it? I think that people, when you're looking at a house, you want to be looking at a specialist app, so they're all laid out the same. You know how the listing's going to work. It's all uniform, and you really can get your sort of comparison hat on. But yeah, I don't think Facebook Marketplace. God, I hope it never gets replaced. by Facebook
I hope not. I mean, that'd be really bad for me as a Rightmove shareholder. But to your point that estate agents hate it, that just makes me like it more. I thought about this for a while because you mentioned this to me a while back that they basically hate it. I heard Buffett talking about Moody's once, which he owns, and he said, look, he basically hates Moody's because they really don't want to have to pay these people for their credit rating thing, but you kind of have to. There isn't really a choice. No one's going to lend you any money unless you have a credit score from Moody's and Standard & Poor's and the other one, Fitch, which isn't listed, so I keep forgetting what it's called. And he kind of sees that as a sort of business strength here of if people pay you money because they have to rather than because they kind of want to, I mean, that kind of indicates that you're quite hard to kind of replace or disrupt.
Yeah, if you're paying somebody through sort of gritted teeth, it usually means that they're either ripe for disruption or they've got a monopoly on the market that can't be disrupted. So I think that's probably what we're seeing now.
Fair enough.